Welcome to Barchart series of webinars designed to enlighten you on a variety of investment ideas, to inform you of the features and tools Barchart provides related to these concepts, and offer some traders insight to help you make a more informed investment decision. Today's session, 3 explosive trends for 2025 you can't afford to miss. Now, market cliches can be campy, like trend is your friend, but they are based in truths and realities. And the discovery of investment megatrends are essential to long-term portfolio asset success. And a megatrend goes beyond a fad or current market sentiment. They are the drivers for capital investment and disruptors that change the world that we live in for years to come. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist. And back in January, we did a webinar that was called Top 3 Investment Megatrends for 2025. So in that session, I identified 3 megatrends: AI, power energy generation, and changing population demographics influencing consumer spending habits. Now, in today's special session, we're going to revisit these 3 themes. We're going to look at, see what's working, how the trends are changing, and what adjustments we can make to continue to benefit from market participation and capital flows. Now, in addition, I'll highlight some techniques using Barchart features that'll help you to discern for yourself these mega trends and recognize market leadership and improve your investing skill set. So stick around, and as I hopefully trend to your friend as we discuss today's disruptors and tomorrow's alpha generators. Now, before we get to that, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Hello there, John. How are you?
I'm doing well. And yourself?
Good. Happy hump day.
Hump day again.
Yeah. Happy Wednesday. Busy week here, and I'm sure that it's busy over by you as well. Lots of stuff happening in the markets.
Yeah, markets have been interesting, and I know we've got a lot of new features and tools on Barchart, so hopefully we'll get a chance to display some of them, but maybe in the future we'll do a whole segment on those as well.
Yeah, sounds good.
Okay, Jean, you ready to jump into it?
Yeah, let's get going.
Okay. Just a reminder, today's session is for educational purposes only, and decisions to buy, sell, hold, or trade in securities, commodities, or other investments involves risk best made on the advice of a qualified financial advisor, and that under no circumstances shall we be liable for any losses or damages that you or anyone incurs as of a result of any trading or investment activity that anyone or you engages in based on information or material you receive through barchart.com and our services. Now, I'm going to add to this disclosure is that during today's session, we're going to be looking at a number of sectors, industries, and individual stocks. And in no way should it be construed as a direct endorsement or recommendation, and the importance of each viewer to do their own due diligence. I'm simply laying out the case for these trends and the evidence of price action of a basket of specific stocks related to these trends. Now, I'm going to share some watch lists to help you get started and give you a jumping off point for your own discovery. But understand that we don't necessarily encompass all the potential stocks which could be influenced by these trends. And of course, our old friend, past performance, is not an indication of future results. Okay, so let's get started, and let's start where we left off back in January, and that was our takeaway was that in this coming year, that market momentum and AI innovation and mega cap leadership would likely remain the drivers for the broader index. And we've seen that, right? We've seen NVIDIA is a classic example, mega cap and AI innovation that has been really kind of holding the whole market together. Now, beyond that, we talked about these transformative trends in generative AI, green energy adoption and procurement, as well as these shifting population demographics that present significant opportunities for capital growth and alpha generation. So there's our basis of where we left off from January. So let's go to, I'm going to go to stocks here, and let me go down here for a second and go to the S&P. Here's the S&P 500, and below here we have the 500 stocks in here. And any of our lists or data sets, or if you're using a watch list, we have something that's called views, and Barchart provides you some default views. We're going to spend a lot of time in the performance view. And since we're talking about what happened in January, that's when we had our original webinar, let's look at year to date. And so you can see for a few exceptions like aerospace, defense, and materials related to precious metals, most are found in one of our three theme categories: AI and that derivative ripple effect from chips to software, energy and energy procurement, and consumer discretionaries. Now, if we look at the NASDAQ, which is more of a tech-heavy index, and we look at our year to date, we'll see that the AI story is persistent and that there's really only one energy constellation and one consumer discretionary, Netflix, that are in the top, let's say, quartile. Now we're going to look at NVIDIA, there it is, as our benchmark, all things AI, so to speak. And you can see the year to date on this stock is about 27%. So we talk about these drivers, right? This ripple effect across industries. And in that session, I identified 4 segments in this space. The AI chip and hardware and integrated systems, hardware and data center buildouts, software and cloud storage, and finally, consumer adaptation and productivity utilization. So under our investing tab, we have AI stocks, and let's open that up. And one of the benefits, again, I told you these views, these default views that Barchart has, but one of the benefits of being a Barchart Premier member is the ability to create multiple views, your own views that allow you to look at certain input data to allow you to do your own investigation. And I have one here, it's called comparative. And one of the inputs that I'm looking at is what industry is this particular company in? And so you can see here is, we're getting a kind of a mixed bag of hardware and software with our hyperscalers. But if we go back to performance and we look at year to date, again, this kind of mixed bag. Here is NVIDIA, and then you can see just behind it is our hyperscalers: Meta, Microsoft, Amazon, Google, Apple. Alphabet. So last time I shared with you guys a watch list, and that watch list was called Data Centers and Power and Parts. Now, these are companies that how data centers are built, powered, and become active. And again, if we look from the performance basis year to date, we'll notice that the top performer today is still the top performer that was back in January, and that is TSSI. And TSSI, if you're not familiar with it, is a engineering, consulting, construction management firm. And this is the kind of the firms that are helping these folks, these hyperscalers, build out these centers. And if we go into flip charts, yeah, it's since the beginning of the year. Yeah, most stocks had a setback in the late first quarter. But you can see that our trend has continued and that every day, I'm reading about new investments in new centers. As a matter of fact, yesterday there was a big announcement. President was in Pennsylvania, announced a $90 billion project. Blackstone just released information on a $25 billion project. Meta, $70 billion project. Zuckerberg says they're going to spend hundreds of billions of dollars on AI centers, and they're going to build one in Louisiana that's going to be the size of Manhattan. So I think this trend is still intact. So let's talk about cloud software and cloud storages. And again, in our past session, we looked at two particular stocks, Pega and Snow, as our jumping off points. So let's go to Pega first. And when you go to any individual stock, under the price overview, one of the nice features that we have is if you scroll down here, you can see industry groupings, and this will allow you. So you might get an idea, or you might read a story about a certain company in one of these spaces. They say, hey, maybe there's an investment opportunity. But what you can do is you go to that stock and then look at their industry group. In this case, this stock is in the service, computer processing, and data preparation sector. And let's open that up. And this will allow you to see not only the stock that you're looking at, but their competitors. And what you might discover is that you might have a great idea on a particular stock, but there are other stocks in that sector or that industry group that are outperforming your stock. In other words, you can find market leadership. So again, in the service, computer processing, data, right? We can see based on a year-to-date performance, yeah, Pega is not one of the outperformers. But in this space, you can see, remember that benchmark, all things AI, around 27%, which is the NVIDIA. There's a lot of stocks that have done pretty well since the first year in this space. The other one that we talked about was Snow or Snowflake, which is in the services and package software sector or group. And again, if we look at this from a year-to-date performance, again, Snowflake is not the market leader, but you can see that in this particular space, it's been very lucrative to every company that is founded, or most companies that are founded in it, in terms of their year-to-date performance. This is a great way to help you decipher or look for the trends based on an idea and then look for market leadership. Now, there have been rapid advances in AI development, and I've started to notice that AI is leapfrogging some of these software as services companies. In other words, companies are discovering that they don't need outside software services. They can do it in-house. They can take their own data, use their own agents, and perform many of these tasks. And so if we look at the bottom half of this top 100 in this particular group, one of the stocks that comes to my mind is you got Autodesk and then DocuSign and Adobe. These all come to mind. So I think in this space, we need to focus more about those companies that encompass multitasking, this idea of agent programming, and not a unique or specific task. And then let's talk about consumer adaptation and productivity utilization. Now, this one is a lot more difficult to pinpoint or to put a direct finger on. But here's an example. Microsoft laid off 9,000 program engineers and announced another 9,000 more to come at the corporate level. So many articles that I've read have estimated that all of code will be written by AI in less than 18 months. So if a company can cut their labor force, that drops right to their bottom line. It's beneficial to them. So I will be concentrating on those companies that have labor-intensive industries that are quickly adopting AI. So again, let's go back to our AI stocks. And the one group that I was thinking about, which makes a lot of sense to me, would be in the robotics. And if we go to the under, not the stocks, but the ETFs in AI idea, and again, we will sort this by performance, the top performing ETF is in autonomous tech and robotics. Now you got to remember, give ETFs a little bit of leniency when we look at year-to-date performance, because it's a mixed bag of many stocks, that diversification that helps diversify risk versus a single stock, which could have a major move or a major outperformance. But again, you can see here for autonomous tech and robotics, about 23% return for the year. Now here's a little trader's tip for you is, make sure when you look at some of these ETFs is that you go into the actual ETF itself and do a little due diligence. And one of the due diligence that I would look at, by the way, this is a really nice looking chart, right? So, I mean, talk about your trend. But what we want to do is we want to look at the top 10 holdings, and you want to make sure that the companies that are in the ETF are the companies are in that space or are in that idea that you want to trade. But go into constituents, and under constituents, what you're going to find is the number of holdings and the percentage of the top 10. So in this case, you can see that the RQ is heavily weighted to a handful of stocks. In other words, the top 10 represents 62% of this particular portfolio. And if you really look at it, it's really these two stocks make up about over 20%. But if we go to, let's say, an ETF, for instance, ROBT, again, in that same space, and we look at their holdings and their top 10, see, their top 10 is only 20% of the ETF, a little bit more balanced, or what I would call more of an equal weight, right? Not really heavy to one. So this is more about what you want to get out of the ETF, your own risk preference, right? And a way to kind of manage that. All right. All right, so let's talk about consumer adaptation. And I think in that sense, let's go back to the AI stocks, is again probably a little bit difficult to put a finger on it, but I would say in my experience is that I'm going to focus more on our hyperscalers, our Googles, our Microsofts of the world. Now, Google just recently released something called MedGemma, and this is an AI agent that can analyze everything from chest x-rays to patient records, and it can interpret and diagnose accuracy over 80%. which is very comparable to humans. Now this is just one of 200 AI agents that they've just released. And we talk about Meta. Meta wants to be all things advertising, from content to creation, marketing to execution. So I think this consumer adaptation story is probably going to be centralized to these hyperscalers, but there could be other opportunities in some individual companies. All right, so that's the AI space. So the next thought we had was the green energy revolution. Now, here we can see that power demand for EVs and data centers is going to increase by grow to 9% of total electricity generation by 2030. Well, that number has changed. In 6 months' time, the market's now estimating that it's going to be closer to 15% and not 9%. So this is something that is accelerating. Now, initially, my assessment was for clean energy, and that was based on what I had learned from industry insiders and the information, and where we were going to find how are we going to power all of these centers, and that the lion's share of that was going to come from gas generation and solar power. Now, since then, solar power has run into a few headwinds, right? We've got tariffs, we've got loss of government credits, but from what I've been told by my insiders is that solar will still be part of the solution. And so it's just that it might just take a little bit longer, or there just might be a little bit more speed bumps for solar. Now, what I underestimated was nuclear, its spare capacity, and the regulators' willingness to restart some of these idle plants. Now, again, if we go back to our investing ideas and we go to our data centers, well, let me see, I think I had it better here off my watch list here. We can see this real quickly. Vistra and Constellation are independent utilities that rely heavily on nuclear power, and they have done very, very well so far this year. So that was something that I had underestimated. But there's a major dynamic now inside of this space, and that AI power is not linear, or the power demand is not linear, it's actually exponential. And data centers can't wait for grid expansion, right? It takes too long, it's too slow. The permitting is taking too much time. You got NIMBYs right now in my backyard, and there are transmission constraints in many of these areas. So what they've decided is that they're going to build on-site generation, and this is going to create a multi-year growth runway across turbines, fuel cells, renewable storage, and emerging small modular reactors. Now, you're going to start hearing buzzwords like behind the meter and microgrids. And AI centers can't tolerate downtime. Grids are vulnerable to extreme weather conditions, cyber attacks, and aging infrastructure. Recently, Texas has a new law that allows their electric regulator to turn off the power in extreme demand situations to AI centers. So the behind the meter solution is going to fall into these four themes: turbines, natural gas, or what you're going to hear is a combined heating and power, CHP. Now, we used to call this cogens. And so here, what I've done for you is I've given you just a handful of companies. Again, I'm not recommending this. I'm not saying these. I'm just saying that these are the companies that are probably market leaders or have leadership in this space. Now, GE Vernova is a U.S. company, and they make the turbines, they make windmills, actually, are in nuclear as well. Siemens is a European company in the same space, and Mitsubishi is in Tokyo, obviously. And so here I'm going to do is I'm giving you the market leaders, but also giving you a little global diversification. Hydrogen-ready fuel cells, Bloom Energy, again, a U.S. company. Fuel Cell Energy is a U.S. company with global presence. And then Dyson Fuel Cells is a Korean company. Solar, wind, and battery storage. Now, again, NextEra is the largest utility that uses renewable energies or creates renewable energy. Enphase would be in that solar space, and then Tesla in the battery space. Now, again, we in our investment segment, so here is clean energy stocks. And again, we can do this from a performance basis. And you can see which are some of the companies that have done well. But again, if we look at ETFs, and we look at from a year-to-date basis, we can see that here we see wind and some clean energy in the iShares. So I don't know for sure which of the renewables, wind or solar, is going to take the lead. I've been told by industry folks that it is solar. I still believe in the story of First Solar. I think First Solar is one of the only U.S. production companies. But what I will tell you is that renewables will not proliferate without battery storage. And so let's go into battery storage stocks. And again, from a performance basis, there are a few handful of these stocks that have done extremely well in the first half of this year. And I would anticipate these stocks will continue to do well. Now, during our session in January, I highlighted EOSE, which is a battery company that is taking a different kind of tack. Instead of looking at, let's say, lithium batteries, they're looking at zinc batteries. But let's look at their chart. And again, they're basically unchanged from January, but they did do well after the April correction. And in May, they announced a secondary offering, which priced in at around $4.20, and that's what created this precipitous fall in the stock. But you can see it has still been trending on. So this is a stock, again, full disclosure, that I have in my portfolio. I just think it's a unique stock story. Do your own due diligence. But I still believe it's in a space that needs to do well in order for renewables to continue to show strength. All right, so emerging SMRs, what does that stand for? Well, that stands for small modular reactors. And this, again, this is the idea that, I've underestimated the nuclear space. But here are three companies I think you can do your jumping off point. In other words, do your due diligence. BWX Technologies, again, a US company. Rolls-Royce, based in London, but in England, which you're going to get a European exposure. And Cameco, which is a provider of nuclear uranium, nuclear material. Again, we can go into our investment page, and here are nuclear stocks. And from a performance basis, you can see that there are a lot of nuclear companies in this space who, again, think of that benchmark that we talked about with NVIDIA, that are way outperforming. Now, I'm just going to give you a quick breakdown here. LU is a company that provides nuclear fuel, in other words, uranium. OKLO recycles that nuclear fuel. NuScale is a company that is going to be in the small reactor, modular reactor space. So they are producing. There's our GE, right? They are in that space as well. Here's Chemical again, who is a company that provides nuclear fuel. So again, there are some other companies. Here's Vistra, again, a utility that has a lot of nuclear capacity. So again, I don't know where this trend is going to continue. I don't know if it's going to be, if you're going to want to own uranium, or you want to own, companies that are going to build these nuclear reactors, or companies that already have nuclear reactors. So again, if we go to our ETFs, and again, we sort by performance, you can see a couple of the ETFs that are performing well. Again, do your due diligence and make sure you can see what the breakdown of their constituents and their holdings to make sure that they represent the companies that you want to invest in. So what I can tell you kind of here is that you can see that, yeah, I think there's a lot of benefits of, being a provider of nuclear material, uranium, but you can see that, the uranium physical and the uranium miners are underperforming this wider basket of those companies that actually have nuclear power or are going to create nuclear power. Let's go back to the stock though, but this is kind of interesting, is that, even a company, for instance, like Duke, right? Its performance year to date is only 9%. But this is an old school utility, and they have one of the largest concentration of nuclear plants in the United States. So here's kind of my take on this is, dare I say that utilities, which used to be, your old, clipping your coupons type of style of investing, that the nuclear space and utilities is becoming a growth sector. I don't think I'd ever say that, okay? Yeah, Duke, by the way, just added into an agreement with Amazon to power a AI center, I believe, somewhere near Greensboro. Okay, so the breakdown in energy procurement and the demand for energy is expanding exponentially, and the grid is vulnerable. So microgrid and behind the meter is the solution. Heck, who knows? 10 years from now, every new home might be built with a cogen, a gas furnace, so to speak, a gas generator, or a nuclear reactor. Think about that. Imagine that and that potential alpha. Okay. All right, so let's move to our last trend and this ideal of an aging population. So every day, 10,000 Americans turn 60, and 4.2 million will be 65 by year's end, and 20% of the population will be 65 or older by 2030. Now, this represents a large segment of our population, baby boomers and Gen Xers, and they have continuously influenced consumer behavior throughout their life cycle. At the same time, they've also amassed a great amount of wealth. Some estimates put their discretionary spending at around 50% of all US spending. Now, the last time we skipped over the medical device because we recognized when we did our segment that the market had already priced in this trend, yet this space still continues to grow. So I would not look at that space, but we focused on quality of life or lifestyle. And the first one that we looked at was housing. So again, if I go under my watch list, and one of the ones, by the way, all of these external watch lists that are not on the investment page will be embedded in the slides, so you'll have the opportunity to look at them. So we looked at two stocks in this group or this space, and one was AHR. There you go, American Healthcare REIT. And the other one was ADUS, which is in the in-home care service. So we see we got one winner and one loser and a little bit of a mixed result. So I think the lesson here for us in this particular space is this diversification of assets, and that, it looks like, right now the demand for senior living homes is more desirable than in-home healthcare. But I still think this is a sector that has a lot of, or an industry group that has a lot of potential, especially as we move, farther down, let's say, the calendar, as we get more and more individuals are in that plus 65 category. Again, this is more of a fragmented segment, which makes it a little more difficult to do our analysis. And the other segment that we looked at was travel and leisure. And I told you guys about my aunt, who's 78 years old, and how she was going to take, 3 cruises this year. As a matter of fact, I think she's already taken 2 of them. But I also mentioned Chef's Warehouse, which is the restaurant's grocery store, basically. And I floated this idea that seniors want experiences and not possessions. And you can see here in terms of performance for this year in this space, that's exactly what we're seeing. But in this breath, let's talk about, there might be some cracks in this one. First of all, in the travel space, in terms of cruises and such, when we do a market analysis, and this is, again, this is kind of an insider's, a trader's insight for you, is when you get above 20-25% away from your 200-day moving average, that's kind of a sign that you're a little bit overextended. And, cruises are typically booked 3 to 6 months in the future. And there has been some talk about, in some of the earnings, that the cruise lines are saying, yeah, demand's still strong, but they're starting to see a little bit of that demand flattening. So, you got to take this in a little bit of a pinch of salt, so to speak. That maybe some of these stocks have gotten a little bit ahead. I still think that these are going to do performance well. The other risk that I see on the horizon is a currency risk, or the dollar risk. And, a year ago, or excuse me, in the beginning of this year, the dollar was 10% more valuable versus the euro. And so companies like Booking Holdings, which is bookings.com, and American Express, they derive a lot of their travel income from traveling to Europe. So that is something that we're seeing a little bit of a dynamic shift in terms of destination demand. Now, there is a company here, Hilton Grand Vacations. Now, I don't own this stock, but I'm actually a Hilton's Grand Vacation member. And I'm going to tell you that a year ago, you could have had your choice of US destinations, but this year, all the US destinations have been booked. So we're seeing this demographic shift of travel in the United States and not abroad. So this could be a risk to some of the stocks in this category. But again, I think we can stay with that idea that seniors are willing to pay for experiences, and there are still many companies in this space that will benefit from that analogy. Now, the other one that we talked about was a quality of life was, excuse me, that folks were living longer. Now, I found this interesting article in McKinsey and Company, it's a consulting firm, that GLP-1s, these weight loss drugs like Ozempic, are creating a demand for medical aesthetics. And again, this is a very difficult sector because most of the industry leaders are privately held. But among public companies, and I'm going to share you, this is a new watch list. Again, this is on our slides. Augmentation and cosmetic companies, you can see that of the public companies, again, let's talk about McKinsey and 3M. These companies are in the one-time use surgical items. In other words, like Band-Aids and gauze and whatever. So they are benefiting from this trend. And AbbVie, again, this is a much larger pharmaceutical company, but they do have a division that distributes Botox. So these are companies that I think that will maintain their dominance in that particular space. But I threw in a couple of ETFs here. One is the genomic revolution, and the other one is healthcare equipment. Now, according to McKinsey article, you want to concentrate on those companies that are doing micro needling, injectables, body contouring, and regenerative products. But beyond that surgical aspect, right? Think about companies like L'Oreal, Herbalife, and Nu Skin. These are in cosmetic therapies like lotions and creams. And you can see that their performance has been doing pretty well for the first 6 months of the year. Now, some of you might say that this is a fad, right? But I believe that this GLP-1 therapy can be applied to all age groups, right? And that's a much larger demographic to draw upon. But this is still evidence that consumers' desires or their wants to look youthful, in other words, seniors, and that seniors have the money to spend in this space. Okay. So let's do this from what I see. Well, we don't have any questions. I don't see, or at least I don't see a lot of questions. Jean looks like she's answered a few of them. So let's move on then. So we talked about risk, and I'm just going to put them all up here. And I think that a lot of these first three risks, there's still risks that we can look at. I don't think there's much change. And for instance, tax, real or hidden. Healthcare costs are going up. Cost of energy is going to go up. So that could constrain some consumer activity. Unemployment, I would think the risk that I'm going to add here is disruption from AI. We talked about, the example of Microsoft. So yeah, eliminating some of your workforce is good for your company, but it's not necessarily good for, the overall economy. Recession and deflation. And again, we can look at some of these risks, monetary policy. Again, I think that some of these things are still up in the air. Persistence of inflation, fiscal challenges, global economic slowdowns. Again, you look at China, looks like it's starting to pick up economically, which is good, but then places like Europe still seem to be lagging behind. Deglobalization, that is really kind of this idea of tariffs, asset bubbles. There's a lot of talk that the housing market has a bit of a bubble. Again, if your neighbor sells your house for $500,000 and you bought your house for 200,000, it's kind of a wealth effect. But when you start seeing a lot of houses on your street for sale and nobody's selling their house, that kind of, puts a damper on that wealth effect. And geopolitical risk obviously will be something that we need to be aware of, but we can't predict in the future. I think this market mechanics one is one that I think is more relevant to us today, and that is that the mega cap weighting in the broader indexes, again, the NVIDIAs of the world, are attracting the lion's share of passive investments. So what does this really mean? It means that, as money comes into the market, a lot of it goes into these ETFs, which are heavily weighted to these large cap stocks. And so some of these companies that we just looked at are in the, I would say, the mid to small cap. And so not a lot of monies or capital inflows would go into them. So you might have the right idea, you might have the right company, and that company might be knocking, out of the park, but it's just not attracting capital because the way the market is structured right now, most of the capital flows into these larger mega cap stocks. And again, I think in that AI space, that's why I think the hyperscalers might be the better choice for that particular adoption space. Okay. All right, so final thoughts here. As we look ahead, these mega trends that are shaping 2025 are not just headlines. They are long duration shifts in real potential and to generating alpha from our energy transition, the surging power demand, this idea of how we're going to get power, how we're going to store it, and the alternative energies that are going to generate it, even as policy and capital costs create regional winners and losers. This explosive rise of AI agents and robotics and demographic behavior that are, for instance, the sweeping adaptation of GLPs, ones, drugs, and reshaping consumer health and awareness. But this is just one of many segments inside of this consumer health and wellness, and I'm sure that a lot of you are probably living a more healthier lifestyle, right? You're choosing goods and services that are more healthy for you, and especially like in the food space. So one of my theories about investing in terms of my investing is, you don't need to think about what is going on globally. Just think about or look what's happening in your own little space, your own little private Idaho. And trust me that if you're making those adjustments and you're making those decisions, that is happening everywhere. So I like to invest in those companies that I'm using, that I believe in, and that are shaping my behavior. So what we're witnessing now is a period of structural transformation, and these are not passing themes. These are themes that are going to carry on for years, maybe even decades. And these are the foundational forces that are likely to define us and generate alpha for years to come. Okay, I hope you guys enjoyed that. I know it was kind of a redo from our January session, but I thought we needed to do some updating, especially since some of the dynamics of some of these trends have changes. I hope you guys enjoy that. Next week, under our Learn and our upcoming webinars, we're going to look at chart patterns, and I'm going to go into the chart patterns. There is a lot of statistical data based on chart patterns. And we're going to look at 5 very particular chart patterns and the work of Thomas Bukowski, the statistical groundwork that he did. And we're going to look at those, and we're going to look at see if we can find some real-time examples of those. So, if you're into like chart patterns and that idea, and I'm going to give you some trader's insight in terms about confirmations and risk management and how you trade these chart patterns, come and check us out for next week. Gene, am I forgetting anything? Is there any last minute questions here?
Yes, Joe is asking, and a few other people have asked as well. Go to the archived webinars page. That's where the session that we're recording right now is. Yeah, and click on the 3 explosive trends. So people are asking, where can they download the slides, the presentation? If you can just point that out here. You're also going to get an email in a couple hours with a link to this recording, but the slides are right there for you to download if you need to reference the watch lists or the different pages that John covered today.
Yeah, what's nice about the slides, and again, here are some of those slides of those watch lists that now these slides were created in the January session, which is kind of nice for you here, is that you can go back here and now you have some reference points in terms of where price was back in January. And so here's batteries, here's senior living, travel and leisure, and end of life. But some of these watch lists were so successful or so popularly requested is that they have now become part of our themes list. Is that correct, Gene? Yes?
You are correct, John.
Thank you. Thank you very much. All right, folks, I hope you guys enjoyed today's session. And we appreciate you guys attending. And if you're watching on our YouTube channel, please give us a thumbs up, drop us a comment. And until next time, folks, with the best of health, manage your risk, and the good of all trading.